Well, as we discussed, it's a hard market for D&O right now. So one that's regulation that has cropped up in some domiciles is specific to directors and officers coverage. This is just top of mind because we actually got a call from a lot of our clients who, saw that, most notably Delaware, now made it legal to insure directors and officers coverage in your captive. And, so we got some calls from some clients saying like, well, I thought I already had, D&O inside of my captive. What's going on? It's really, what was interesting is that directors and officers breaks down into several different forms of coverage. And the two most important are Side A and Side B. So Side A coverage provides protection to the actual officer or director if he gets sued personally and the company is unable to cover his legal costs. And this could be if, the company goes bankrupt and there's just no money to do it, or it could be if the shareholders, let's say like what's called a derivative suit. And so they come after the shareholder or the officer individually, and the company, wants to wash their hands of it and not cover them. So that's Side A. Side B is more standard. It just reimburses, for any costs that the company actually does pay. And so historically, nobody really cared because, you would write D&O coverage. It was fairly inexpensive in the traditional market. If you did it in your captive, that's great. You would just reimburse the company for anything, any claims that, they paid out to protect their directors and officers. But as we discussed earlier, now D&O is all of a sudden, it's become an expensive item for, companies in the cannabis space, the crypto space, some of these emerging technologies. They have to have the directors and officers coverage. And where the domiciles would be concerned is when a captive wanted to provide that Side A coverage. Because, by definition, that Side A coverage is providing protection to an officer for something that the company can't or doesn't want to pay for. And so if you have this, owner controlled captive and they're representing that they have Side A D&O coverage, it creates this inherent conflict of interest, that can be tough to manage around. Or in the case of bankruptcy, if the captive is a wholly owned subsidiary of the company that just went bankrupt, then it raises questions about, hey, is there, are there really funds there to provide this coverage? So, and that wasn't really anything that needed to be addressed because again, it was, historically an inexpensive coverage. But what happened was, the regulators, to their credit, there's put design parameters around it, and you can address these issues pretty well by doing a couple things. One, mandating that you have an intermediary, specifically a fronting carrier, which, for those of you not familiar, a fronting carrier is an A-rated admitted insurance company that issues the policy on behalf of the captive. So it's not the captive issuing the direct policy. It's, it's another carrier. And then the captive just acts as a reinsurer to that fronting carrier. So you have the fronting carrier that's issuing the policy. Ultimately, it's their paper. And importantly, their claims handling that are responsible for adjudicating the claim. So by putting that piece in there in the regulation, it required that, okay, hey, there's going to be an independent third party that's going to adjudicate this claim separate from what the, the owner controlled, captive may decide. And then when you install that fronting company in there, they're always going to make sure, because again, it's they're the ones issuing the contract to the insured. They're going to make sure that there's adequate monies there, either in the form of capital, premium, or reinsurance to satisfy the claim. So that was something that interesting that came up. People were doing it, kind of at a small level one way, and then now it's really matured into a strategy for larger insureds now that the market is expensive. So that was the thing that sprung to mind there.